Welcome back to the channel. Today we're diving into something that's been quietly performing in the financial markets for years, yet hasn't always gotten the attention it deserves: SCHD, the Schwab U.S. Dividend Equity ETF. Now, this isn't a video about hype or sensational predictions. This is about understanding how this ETF works, why it has been consistently strong over the long term, and how it can play a role in building a portfolio that not only grows wealth, but generates a steady stream of income over time. If you've ever wondered whether SCHD is worth holding, whether it's still relevant in 2026, or how it could fit into your personal investment strategy, then you're in the right place. I'll break it down in a way that's clear step by step, using real numbers and examples so that you can see exactly how this fund could impact your financial future. By the end of this video, you'll not only understand why SCHD matters, but also how you could potentially set yourself up for decades of financial growth with minimal stress. This video is for informational purposes only and is not financial advice. Always do your own research or consult a professional before making any investment decisions. Let's start with the basics. SCHD hasn't always been the top-performing ETF over the past few years. In fact, if you looked at the last 4 years, it might not have felt stellar compared to high-flying tech or AI stocks. But the reality is, if you zoom out and look at the long-term track record, SCHD has consistently delivered strong performance. Since its inception, the fund has produced an average annual return of over 12% per year. Yes, even factoring in those years where many investors were frustrated with its performance. The long-term data paints a clear picture of growth and stability. What's even more impressive is the dividend history. SCHD has maintained a steady dividend yield hovering around 3.8%, and that dividend has grown every single year, often by double-digit percentages. This is not just a coincidence. The fund's focus on high-quality, dividend-paying U.S. companies ensures that shareholders benefit from both price appreciation and a rising income stream. Now, why does all this matter? Let's do a simple thought experiment. Imagine you have $100,000 in your portfolio, allocated entirely to SCHD. You're holding this in a tax-advantaged account, like a Roth IRA or traditional IRA, so you don't pay taxes on your gains or dividends. With the current dividend yield of 3.8% and assuming a conservative dividend growth rate of 7% per year, combined with a conservative annual share price growth of 10%, here's what happens. Over 20 years, that $100,000 grows to more than $1.1 million. By that point, your annual dividend income alone would exceed $25,000 per year. Now, let's take this one step further. If instead of just letting that $100,000 sit, you added $1,000 per month over 20 years, your total portfolio could grow to over $2 million. At that point, your annual dividend income would be nearly $50,000 per year, which translates to almost $4,000 per month, generating income for life without ever touching the principal. This is the power of compounding combined with dividend growth. Of course, SCHD is not the only way to invest, but it's important to understand how it fits into the bigger picture of portfolio diversification. Think about your portfolio in 3 categories: market average exposure, such as the S&P 500 or the total U.S. stock market. This gives broad exposure and tracks the general market performance. Lower volatility or value-focused ETFs like SCHD or VTV, which tend to be more stable and offer reliable dividends even when the market is volatile. Higher risk, higher reward assets, such as tech stocks, AI companies, or cryptocurrencies. These can generate huge returns but come with more volatility. During the last few years, when tech was booming and SCHD was underperforming relative to the broader market, I never advise people to abandon SCHD. The point is balance. Even if part of your portfolio is underperforming in the short term, maintaining allocation in reliable dividend ETFs ensures that your overall portfolio doesn't experience extreme swings. When tech or growth sectors are down, SCHD can help keep your portfolio afloat and still provide meaningful income. When tech is up, those sectors lift your overall returns, and SCHD continues to pay a reliable dividend. It's a win-win scenario. Let's focus on why SCHD deserves attention this year and moving forward. There are 4 key reasons why this ETF should be a core part of your portfolio in 2026. We're seeing this in real time. Bitcoin is down, AI stocks are struggling, technology in general is underperforming. Investors who made large gains over the last few years are now reevaluating their exposure to riskier sectors. Many are taking profits and looking for safer places to park their money. Money market accounts, high-yield savings, and bonds used to be go-to options. But with rising inflation, the real return on these instruments is shrinking. Investors are seeking safe equities that still provide growth and income, and SCHD fits that bill perfectly. A new Fed chair is expected to implement policy changes starting mid-year. This could drive interest rates down, which will reduce yields on cash accounts, savings accounts, and certain bonds. That means cash is no longer a reliable source of growth or income. People will naturally shift some of their assets into ETFs that provide a higher dividend yield while still offering stability, making SCHD an attractive option. One of SCHD's strengths is its underlying portfolio. The ETF is heavily weighted towards sectors like energy, consumer staples, healthcare, industrials, and financials. These are relatively safe, recession-resistant sectors that provide stability during market turbulence. The ETF avoids heavy exposure to technology, and no single holding dominates the portfolio. No individual stock accounts for more than about 4%. This diversification reduces risk and makes SCHD an ideal component for anyone looking to protect their portfolio while still earning dividends. SCHD's historical performance is remarkable. Even in its worst year, the fund declined by only 5%, which is far lower than most equity ETFs, which can drop 30% or more during market downturns. This history of stability makes SCHD a valuable tool for investors seeking to reduce volatility and preserve capital. While past performance doesn't guarantee future results, the long-term data indicates a resilient investment that can serve as a foundation for a diversified portfolio. So how does SCHD fit into your portfolio? The answer depends on your risk tolerance and investment goals. A balanced approach is key. For example, you might allocate a portion of your portfolio to SCHD, another portion to S&P 500 or total market exposure, and a smaller portion to higher risk, higher growth assets like tech. Even with just one portion of your portfolio in SCHD, you can generate meaningful income through dividends. Meanwhile, the other parts of your portfolio can handle growth and higher returns during bull markets. In down markets, SCHD provides a stabilizing force, keeping your portfolio afloat and continuing to pay dividends regardless of broader market swings. This approach allows you to weather volatility while still taking advantage of growth opportunities. You're not abandoning tech or high-risk assets entirely. You're simply allocating wisely to reduce overall risk and generate sustainable income. Over time, this method can compound into substantial wealth and long-term financial security. Of course, no investment is risk-free, and it's important to consider both sides of the equation. SCHD is not immune to market downturns, and dividends can fluctuate. The key is understanding your own risk appetite and constructing a portfolio that aligns with your goals. Ask yourself, how much risk am I comfortable taking? What's my investment horizon? What portion of my portfolio should be allocated to high-risk growth versus stable income-producing assets? These are personal decisions that require careful thought. There's no one-size-fits-all approach, but data-driven strategies like incorporating SCHD can reduce stress, improve stability, and enhance long-term returns. To summarize the practical lessons from SCHD, steady growth and dividends. Even during periods of underperformance relative to tech or growth stocks, SCHD continues to pay a reliable dividend and grows over time. Diversification and stability. Its sector diversification and limited exposure to any single stock reduce risk while still offering long-term growth potential. Portfolio insurance. SCHD provides a cushion during market downturns, protecting your portfolio and providing income even when riskier sectors falter. Long-term potential. With consistent compounding and dividend reinvestment, even moderate contributions to SCHD can grow into substantial wealth over decades. Investors who stick with a strategy that includes SCHD often find themselves well-positioned for financial stability, both in good times and bad. This ETF is not about chasing the latest trend. It's about building a portfolio that lasts, generating sustainable income, and preserving capital for the long haul. So there you have it. A detailed look at SCHD, why it remains relevant in 2026, and how it can be a cornerstone of your investment strategy. This ETF is not about short-term excitement or chasing tech gains. It's about consistent growth, reliable dividends, and portfolio stability. By understanding the fund's history, its structure, and its role in a diversified portfolio, you can make smarter decisions that align with your financial goals. Remember, investing is about balance. Even in a world of volatility, SCHD offers a predictable, steady path toward long-term wealth. It's a tool for building a portfolio that pays you back consistently, allowing you to live off dividends one day while maintaining the growth potential of your other investments. Now it's up to you. Consider your risk tolerance, your goals, and your timeline. Think about where SCHD could fit in your strategy and take action thoughtfully. The market may be unpredictable, but disciplined, data-driven investing can give you the peace of mind and financial freedom you're looking for. Thanks for watching. If you found this helpful, don't forget to like, subscribe, and hit the bell so you don't miss any updates. See you in the next video.